Your questions should be focused on the economy and business in general. Behind the Markets, 20 a.m. on Money FM, your business talk radio station. All behind the markets on Money FM.
Hello, how are you, Mr. Mutwale? How is the day so far?
And good morning to you, Vernon, and good morning to everyone else on our live post NPR meeting, where we are going to basically dissect the first rate hike that has occurred in Zambia since the first rate hike that has occurred in Zambia, I think, for over a year now. So this is the first time we've actually had monetary tightening interest rates. So thank you to everyone who has joined us today on Money FM on Behind the Markets as we break down this change of events, or this actually new style of events that have taken place. Now, we do have a few points that did come out of that NPR meeting, but the MPC, the Monetary Policy Committee, did announce yesterday that they are raising interest rates by 0.25%, the policy rate, the rate at which they front load to the rate at which they front load to the banking sector. And that's basically driven by the fears of rising inflation, and inflation that seems to be on an upwards trajectory. I think the governor mentioned that multiple times. He said, look, inflation is now on an upwards trajectory, and we do need to start acting in accordance. So today we're going to pretty much dedicate today's session to breaking down a few glimpses and a few things that did come out of there. Now we also did manage to get a few of our questions in. About 3 of our questions that we posted yesterday, that we talked about yesterday, actually came into the conversation, and that was pretty much good for the viewer yesterday. But kicking off today, we can see that the Kwacha has now gone officially, Vernon, into pre-election territory of 19.3477. Now we do have, that means that our Kwacha is officially weaker than it was before the president had walked in, and therefore all the confidence has pretty much been wiped away. So we do have a few, as I said, we did manage to get a few questions in regarding what's happening in that state. And those are things that we will try and address. But as I said, it was due to higher than expected inflation. They said, look, there was moderated financial vulnerability. They did address that. They said, look, financial vulnerability has moderated in this period. So therefore, they do feel that it is a time to start dealing with it. Now, obviously, the main concerns that have been coming from a lot of the corners of the economy isn't raising the MPR going to cause inflation? Isn't raising the MPR going to cause an economic slowdown? So here are some of the points that the governor did mention regarding this. Now, here's some of the highlights that we've picked up here from the MPR meeting. For everyone's sake, this was something that we just pulled out of yesterday's meeting. He did say that inflation for 2023 is projected at 11.1%. Now, this is an upwards revision from the 2022 inflation expectations of 8.5%. So that was a big change that we've seen. That was a big change that we've actually seen from yesterday. So we saw it as zero at. That means that we were expecting inflation trends to start coming down from 9.9 to 8.5 this year. But given the January inflation read and the concerns that have been building up, and there are some points here, and they've said that, look, 10.1% also is the inflation expectations or inflation forecast of 2024. So even this thing of getting back to the 6 to 8% range by the end of 2024, remember that we were supposed to, even just sometime this quarter, actually. In fact, the plan was sometime this quarter, we were supposed to get back to the 6 to 8% range. Now it's looking like sometime in 2025, we start to get back to 6 to 8% inflation range already. So because there has been some upwards factors, and 3 factors that the governor did cite was, 1, FX devaluation, mainly brought on by monetary tightening. The monetary sector has actually been doing a lot of tightening around the world. In other words, the central banks have still been raising interest rates. Though they're starting to slow down on it, it is still causing people to move out of kwacha and into the superior currencies or the main developed nation currencies. The other thing we said, obviously, is the negative sentiment from protracted debt negotiations. So the longer this keeps going, and this is why I keep saying the Chimerica rift is a big threat to Zambia, because the fact that America and China are debating over what is happening over our debt, those are some serious situations that we need to deal with. Now, the other factor that we saw, yes, that we're looking at, that they saw in terms of inflation, was lower maize yields, potential for lower maize yields due to adverse weather conditions and potential with army worms that have started. I'm thinking these floods are probably going to wreak havoc in terms of our maize output this year. So prepare yourself for a lower maize yield, which might push up prices already. So we're already on the foundation of a higher maize price. It might look like it's going to stay persistently higher, or at least hold the position, or even get higher at least. It might stay persistently this high or even get higher. And then you've also got expected electricity tariff revisions that might actually come into play. So this is your inflation outlook. So if you're running your business, run your inflation outlooks: 11.1% 2023, 10.1% 2024. Do your business expectations, your costings. If you're running your investment portfolio, are you investing in assets that are higher than 11.1% return on investment? Are you catching yourself in assets that are higher, that are over the next year, 10.1%? Make sure that you're going deeper into the bond curve for return on investment. Remember that yields don't always result in higher return on investment, but you want to try and look at that. What is your best option to get a good return on investment on your assets? This is the time to start thinking about that right now. So this is what we're looking at in terms of your inflation output as given to us by the central bank. Other things that the central bank did cite yesterday has to do with our currency markets, and this is actually quite interesting. When you look forward into our currency markets, the governor did actually point out that the central bank had sold $444.3 million into the market. This is 32% higher than the previous quarter. And if you look at quarter four 2021, this is 203% higher. So they really sold a lot of FX during this period, trying to see if they could stabilize and regularize the currency. But still, there was a lot defensive. There was a lot of trading against the currency. And if you look for the year end, the central bank has sold $1.5 billion into the economy, 23.5% higher than the last year. Yet the currency is still weaker. So the factors that are driving this is, one, offshore bond exits. And now the governor did actually cite that we have global monetary tightening, one, and negative sentiment. And what we're also seeing is fears from the offshore bondholders, because there is pressure. There's a pressure campaign that is mounting to try and make sure that offshore bondholders are included in the haircut negotiations. Now, I want to stress this very carefully. Not domestic, not Zambians who own government bonds. They're talking about foreign companies like JP Morgan, Chase, all these other offshore investors who buy up government bonds. There is a conversation being had about including them in also getting themselves a haircut for their government bonds, and specifically the long-term ones. Okay, because they're holding a lot of long-term positions very cheap, and it is a huge component of government debt. So I'm going to say this again. This is not, I repeat, this is not this is not the foreign, the local investors being asked to take a haircut. If you hold government bonds, you're a Zambian, you're not being talked about to hold a haircut. Not even a Zambian local bank is being talked about to get a haircut. They're talking about offshore global investors. I'm repeating this sentence multiple times because I know someone's going to misquote me on this. So let's try and make sure we get this correct. Okay, don't get into a panic. But what they are talking about is offshore investors. Now, a lot of these offshore investors are becoming very uncomfortable entering the market to bring Forex in. Just to give you a simple example, in quarter three 2021, about $300 million was brought in by the mines. $400 million was brought in by the mines in terms of FX. Now, if you railroad that backwards, it was the finance sector also brought in about $200 million. So your currency gets stronger when your offshore bond investors are bringing in dollars, parking them in 10-year bonds because they're confident about your economy. So that's the first thing that you really want to focus on. So you do see that your offshore investors are a bit timid to come in, one, because of global monetary tightening, and they feel that they're better off rotating back to their economy. Two, because they don't feel comfortable with the current debt negotiations. And three, because debt negotiations are now including conversations about pressuring offshore bond investors who own local government bonds to also take a haircut. So these three things are deterring money from flowing in. The other things that we're seeing is obviously lower mining FX supply, lower dollar supplies coming in from the mines, and also lots of few imports from pharmaceuticals, fertilizer, and fuel. These are your three issues that are taking money out the country. So let's break down into this issue that the governor spoke about regarding the supply of FX coming from the mining sector. Supply of forex coming from the mining sector. If you look here, he actually showed this chart, and we extracted it from the video. Unfortunately, we couldn't get it from any other source. You can see that the dollars coming from the mining sector into our economy has actually been performing rather poorly. And if you tie this to trade levels, we've actually had very poor trade, 3.3% trade earnings in terms of mining sector, traditional export earning in terms of a contraction, 3.3% of a contraction in mining revenues, or mining export revenues throughout this period. So we are having a little bit of a problem with our mining sector, and it's not auguring well that we gave our mines a huge tax break, and unfortunately, we're not seeing the dollars flowing into our country as a result of that huge tax break. Hopefully, then this just means that it'll take a bit of time for them to invest and grow their output or grow their capacity, but we shouldn't be seeing less money coming in from the mining sector when you start to give them a bit more tax relief. So we should actually see a stronger recovery. Now, economic growth signs are showing that the mining sector is about to pick up, but unfortunately, trade data is not supporting that. 2022 trade data showed a poor, weak, and declining mining sector, which is not doing too well. So as you can see, especially the second half of the year, we peaked in quarter 2 2022 in terms of mining revenue, but we declined. So let's take a look at even our mining revenues that we've been getting as a country. If you look at quarter 4, you can see mineral royalties. We got $106 million in terms of mineral royalties, which is 35% less than the previous quarter and 42% less than quarter 4 2021. So already in that quarter, we had very poor revenues coming in from the mining sector, $106 million from mineral royalties. But at least for the year, we saw a 0.52% rise in mineral royalties. That was mainly because of quarter 2's serious jump up, where obviously this was probably remittance from the first quarter, where we had very high record levels. We had very high copper prices before the Russia-Ukraine situation kicked in. Then other taxes that we're actually starting to see as well, other taxes from mines. This is other mining taxes. We saw $78 million of other mining taxes, which is down 37% from the previous quarter and down 50% from the last. This is mining profits and other mining payable taxes. And we saw other mining taxes, $587 million, and that's down 9.7%. So in total, the dollars that are flowing in from our mining sector in that quarter were $185 million, 36% lower than the last quarter, and 45.97% lower than the previous year, same quarter. And we saw $1.3 billion worth of tax revenue coming in from the mines, 4% lower than the previous year. So evidently the slowdowns in mining and a bit of poorer pricing that has happened in the second half of the year has therefore metastasized into the FX risk we were talking about at the beginning of the year, when we could see, not at the beginning of the sorry, at halfway point of the year, when we could see mining output was sliding and we could see mining incomes were getting worse and worse. So these are the things that we have to try and watch out for. This is what's causing your FX problem. I think bigger than the imports, it's the combination of poor participation of your offshores in your bond market and your mining industry giving you much less dollars than you hoped for as an economy. I think this is what we should try and address, or at least mineral growth should try and address. Other factors that did come in from the governor's speech is he did talk about credit expansion. Now we saw an 18.7% credit expansion during the period. However, we did see that that was 10% of that came from the private sector, while the other 8.6 came from the public sector. So that was some of the points that we picked up from there. And we did see this translate to a 24.5% money supply growth versus 13.1%, 13.3% year-on-year money supply growth in quarter 3 2022, and a 4.3% money supply growth in quarter 4 2021. So even the argument about there not being money in circulation has started to dwindle, because now we're actually seeing that circulations are starting to pick up again, and more of it is going to the private sector than it's going to the public sector. So we are starting to see that splinter off. However, the main concern that we are seeing, obviously, is that lending rates are still held up at 25%. So that's something that we should actually pay attention to in terms of this. The other part, the final part that we did see, is that the governor did state that growth was moderated in quarter 4 2022, but the medium-term growth the medium-term growth outlook is optimistic, with recoveries expected in mining, agriculture, and construction. GDP data is showing that mining and agriculture are in the middle of a recovery. I'm not sure about construction, but we should start to see signs of it. One reason I would think there should be some hope in construction is mortgage data. We did see mortgage loans triple from year to year over last year in terms of the banking loan book. Seeing that tripling of mortgages should signal that we should be seeing a bit of a construction boom, because effectively that was a growth. That's effectively a growth of over 1.5 billion kwacha worth of mortgage loans issued. That's tens, if not hundreds of thousands of homes that should be getting built. Sorry, not tens of hundreds. That's about tens of thousands of homes that should be getting built, and that should actually try and help now with the mortgage. That should try and help with the construction sector. Should we be seeing it in terms of that? Not sure. Now, growth is expected to continue in financial services, ICT, retail, and wholesale. I would also add education. Free education has actually helped the private sector schools during this period, because they're now experiencing higher than expected enrollments and applications towards their schools. So this is the data that came out of it. Just to give you a quick summary, yes, the MPR was raised up by 0.25%, and we're going to break down what that actually means for people. And the second part that we also saw is that inflation, I think a bigger piece of news for as many of you right now, is actually this point here. Inflation is up 11.1%. Inflation expectations for this year have been revised up from 8.5% to 11.5%. So even that 9.4% that we saw in January, that is just base effects. We're expecting to end the year at 11.1%, mainly because of that big bump that we saw. And we're probably going to see even another one, especially that we've seen taxi drivers, the Taxi Association pushing up their rates as well due to fuel prices. And that's also being reflected by the FX rate. And also 2024, we're still expecting 10.1% forecasted inflation. So this is up above the 6.8% range that we're expecting to be in 2024, meaning that we're only going to be between 6 to 8% inflation, probably in 2025. So look for assets, people. If you're trying to do your savings, look for assets that give you access to, look for assets that are inflation growth based. Okay, when you're the ones that thrive during rising inflation. So we're talking about inflation. We're talking about what's it called? Stagflation assets, which are your short-term bonds, your 2, 3, and 5 year. Those are called stagflation assets, and your inflationary growth assets, which have to do with hard assets or essential stocks. You're looking for stocks that sell or stocks on the market that sell essentials to consumers with pricing power, because you're looking for inflationary boom assets. Okay, so that's those are your core things you're trying to look at. Part of your property sector might take a hit, so maybe you might even start to see that things like rental costs may start to go up because of that. But your business sector, in terms of growth stocks, who are relying on a low interest, low inflation environment to be able to grow, they might start to stagger a little bit during this period. So you're looking for the essential stocks, and if you're going to start picking stocks, look for companies that are developed. That's kind of what this kind of inflation environment is telling you. Simultaneously, I'll also give you that the other slide is showing the resilience of our FX losses, that the central bank has literally been offloading dollars, but still they're offloading dollars at record rates into the economy. But still, the economy is still resisting it due to lower mining FX supply and higher than usual pharmaceuticals. Usually as Zambia, we're usually importing fertilizer and fuel. Those are usually the things that put pressure, and the mining sector offsets. I think the addition of healthcare costs due to a pandemic and pharmaceutical costs is putting an enormous amount of pressure. That's actually making this a more than a worse situation than we thought. So FX stability is actually at risk at the moment, and I think this is why they also have to act. That 0.25% and the movement of the statutory reserve ratio is really aimed at targeting this FX movement. The part that the governor has said, the FX devaluation in a tightening cycle. So we've been afforded the luxury of not tightening our monetary system during this time, because we've been trying to at least give our economy some time to breathe. But unfortunately, we do not have that luxury anymore. We need to catch up with the world and start tightening with them. And also at a time when there's too much negative sentiment and the conversations are scaring away a lot of people when it comes to bond trading. So that's some of the data that we have from yesterday. Now we have a few questions that we captured on video and a few answers to some questions that we captured on video quickly. But let's address some of the questions I think people have about the monetary policy rate. Wix Mulu was asked, saying the deputy governor warned banks to minimize making profits on government securities as they may face the risk of yields collapsing. So what is really happening? So what my question is really, what happened in 2006 in government securities? Now, if you're answering the question, what really happened in 2006 with government securities, here's a simple thing. In 2006, what we saw was inflation really drive this and a lot of debt. Government securities in 2006 were really expensive. So I mean, yields were really high. We were talking about before 2006, they were really high. In fact, in the 90s, we're talking about like 40% yields on 2-year bonds. Simply because inflation was also through the roof. So as high as inflation was, government securities were even higher because that was the rate at which money was being traded at. So for us, we have to try and make sure that you understand that in 2006, what then happened is HIPC comes in, we get debt forgiveness, and what started to happen is that interest rates collapsed. Because there was a lot more capital that started flying back into Zambia. And in 2007, you even see the first 15-year government bond issued. You see 7-year, 10-year, and 15-year bonds being issued, and offshore investors are a lot more comfortable coming into Zambia, parking in dollars and parking in money for a lot longer period at lower rates. So that's what happened in 2006. Now, that was mainly because there was a rush of capital that came back in because the government did structural fiscal reforms. Okay, that's what they've been talking about. Once you do fiscal reforms as a country and you allow yourself to be pro-growth, your offshore bond investors are more comfortable buying your government bonds, and they come in with a flood of capital that then increases the strength of your currency and also lowers your interest rates, because an offshore investor does not really want the 22%. They're just trying to beat 2% inflation in their country. As long as your FX rate is stable and they're trying to beat 2%, they're comfortable with a 10% yield. But a Zambian investor is competing with 11% inflation and 10.1% inflation in 2024. So they want return on investment at least 15, 16%, 16% and above, to at least get 5% above inflation, if not 6% above inflation. So that's what your Zambian investor wants. So the battle between the offshores and the Zambians brings a lot of this down. So that's where it comes down. Now, it does eventually even benefit the Zambians, because when the offshore comes in, they bring in the dollars that then strengthens the currency and then cheapens the cost of imports, and therefore the imported inflation starts to calm down as well. So it does offset inflation in the eventual period, but it does bring down yields potentially. So that's what happened in 2006. That managed to bring the government securities yields down. So that's the first question that was answered. Mr. Walia Kangwa is now asking, let's just put his question up. So in morning, Munyumba, governor mentioned there's a possibility of a haircut included, to include local bonds as part of debt restructuring. Is it feasible? Does it apply to resident bondholders? No, it does not apply to resident bondholders. It's specifically targeted at offshore institutions who own bonds. It's specifically targeted at that. They're not targeting they're not targeting banks in Zambia. They're not targeting individuals. They're not targeting offshore individuals. They're targeting institutions who, like JP Morgan, for example, or like these other main banks, these bigger banks that play in the government security space, who have got euro bonds and then quickly ran into government bonds. Those big institutions who are told, even your local bonds portfolio, you need to hold that. We need to bring that to the table for you specifically. Okay, so it's not targeted at everyone else, it's targeted specifically. Now, it is not something that's actually happening, it's pressure that's mounting. The bondholders are saying, no, but include these offshore guys. There's some guys among us here who are holding domestic bonds. They also need to be brought to the table for a haircut, because Zambia's domestic bond is too high as well. Zambia's domestic bond holdings, domestic bond stock is a bit too high, and a lot of it has to do with offshore holdings. But the thing is, I'm not sure how feasible this is, because offshore investors are already selling. Like, we've actually seen a reduction in our bond holdings from 32% offshore investors down to the lower 20s. They didn't mention the percentage yesterday, but in the last reading that they did, our offshore investors were down to 24%. In fact, banks and NAPSA are holding more bonds than offshore investors now. They've exited quite a lot of their positions and sold it to banks and NAPSA. So the banking portfolio of bonds has been held mainly by two things. One, by government contractors who were given government bonds, and they bought and they used those to quickly liquidate. So that's part of what banks did to acquire bonds. Two, offshore investors who wanted to early exit because they were worried about their portfolios getting a haircut. So this is what you've seen the banking stock expand drastically. So I just wanted to put that out for everyone. Now, there was a question that was posted quickly about the first question, I think, that generally is posted, and we got one yesterday, which has to ask, what are the repercussions on small businesses? Well, here's the reality. In the short term, credit does become tight. That's a reality, okay? Credit does become tight, but the tightness of credit was not a function of MPC rates, because even if you look at the policy rates, they sit at 9 to 9.2%. But when you walk into a bank, Vernon yourself, if you walked into a bank, you think you'd get 9% or anything close to that as a loan rate for a year? No, you're getting way more than that. The people who are going for microfinance are sitting somewhere in the 70%. The banks are issuing 30s and 40s to people. You're still high risk. Okay, so the problem where the rates are coming up from is that the rates of return that banks are making from government securities, which they find zero risk, is still 25%. Now, in the short term, we've seen that treasury bills, the treasury bill yield, or the amount they're making on treasury bills, is down to 17%, and therefore now they're starting to become more attractive to lend to people. So the trick here, people, the real trick is not about that MPC rate. The real trick is about making it more profitable for banks to lend to businesses and people than it is to lend to the government. That's what we need to try and fix here. Because once banks are lending to businesses and people, then we can start to talk about what the rates are doing and what the rates are not doing. But for now, the issues that we're facing is that government yields are still way too high. Okay, and that's not a function of the MPC. That's a function of poor sentiment and a lot of government debt and bad government budget management before, which has to be reformed. I think if you've seen in last year, we gave you the data that in the banking sector, the government borrowed, in the lending sector, the government borrowed 80% of, not 80%, 9 billion kwacha. Now they're down to 2 billion kwacha in 2022. The expectations that when it close 2022, the government having only borrowed about 2 billion kwacha worth of debt. So that changes a lot of the perspective. That's government exiting, and that's why you're seeing small business loans were increasing from 2.5 billion to 2.2, almost 5 billion during this period. We also saw the same thing for household loans, going from 5 to as high as 14 billion by the end of the year. So we are seeing the growth of the smaller sectors of the economy being able to get more money, especially in the shorter term. So what you will see is that short-term access to capital is actually still improving, but the problem is long-term. And even what you've seen here, so will it have that effect? The other thing you also have to take into consideration is your FX rate. As a small business, you will say on one hand, I want access to capital, but you also want a cheap environment to operate in. So you got to be careful here. Your cheaper access to capital is costing you your cost of doing business. It's actually creating a higher cost of doing business because there's too many kwaches in the system. Okay, so you have to pull that back. On one hand, you'll say, but I want access to the bank. Then the other hand, you'll say, yeah, but things are becoming too expensive. How am I going to do business? So it's a balancing act, unfortunately. This is where the governor is caught. It's caught in a horrible balancing act where he has to try and figure things out. Now, I know one question that we always get asked by people is, can someone explain this to us, simple terms, on how this will go to the local common people? Okay. Your rates of lending. Okay. Here's what happens. The rates at which you get from a bank. Okay. The bank borrows you money at an interest rate or lends you money at an interest rate. That interest rate is determined by two things. One, how much did it cost them to get that money? Okay. So they get money from the central bank, they get money from depositors. That's what you need to look at. A bank gets money from the central bank, it gets money from depositors, it gets money from its investors. These are the three main sources. Investors come in for equity and sometimes even for some other sorts of debt, but mainly they rely on depositors and the central bank. So when the central bank raises its rates, it means that the depositors are expected to get a little bit of a higher rate. Okay. So the cost of savings to the bank, remember, the bank has to pay out these people who save money. And also the reserve ratio, meaning they're no longer allowed to use 91.5% of their money. Sorry, 90.5% of the money. Now they're only allowed to use 80%. So they're only allowed to lend out a smaller portion and they have to pay out a bigger interest, meaning that for the banks to be able to sustain that and be profitable, they have to raise interest rates on people. Okay. So in order for them to sustain paying off these debts and be profitable. The other thing that determines your interest rates is also what rate the government is giving out. Whatever interest rate the government is giving out, because they're considered risk-free, you're considered risky. Okay. So you as a person, so risk is in this category. Government, lowest risk. Second lowest risk, big business. Then you've got institutions. Then you've got small businesses and households. Those are considered the most risky people to lend to. And the higher risk you are, the higher interest rate you pay because you're compensating that institution for taking risks lending to you. So just want you to understand that very quickly. It's got to do with risk. Okay. Finally, we just want to capture some of the questions that were asked yesterday. And this was a question that was asked, thankfully, by our own Cecilia, who managed to pitch this in, and we also want to thank her for it. And this has pretty much got to do with the central bank and the record profits in the banking sector. The central bank and record profits in the banking sector. So just give us a quick point as we now just quickly transition to this. This is specifically a question that was asked specifically to do with record profits in the central bank. So record profits in the banking sector.
Profits in the bank. As the central bank record profits in the banking sector, driven by bond trading, as opposed to lending as a threat to the social fabric of the nation, as it seems to be stimulating economic inequality more than of broad-based inclusive growth, especially given that this was supported by Bank of Zambia refinancing credit lines.
What is clear from the two periods, 2022 and 2021, of course, the banks have posted very significant rise in profits. And what we see from that is that, for example, I think over 50% or just over 50% of that is coming from investment securities. Now, we've been very clear with the banks that at the end of the day, financial sector has to support the real economy if we are going to grow. And part of the big investment in government securities, as you were sort of inferred in the question, had come initially risks were heightened, banks were really pulling back from lending, And the efforts that the Bank of Zambia has made was to say that, look, we must make sure that the financial sector is protected and that the banks can also support firms out there. And the message which we are giving is this, is that the structural reforms which the government is taking, already we've seen a significant reduction in the yield rates on government securities. The governor was just talking about the importance of the structural reforms being made, deficits coming down, and yield rates coming down. And we have a precedent for this. In 2006-7, after HIPIC, we saw a collapse in government yield rates. And what we are telling commercial banks is that this reliance on government profits is actually a risk. And this is an active engagement we are having with them, because the progress which the government is making, these yield rates will collapse. And then the banks will have to come back to businesses and individuals to make money. And so this is it's a very important issue which we recognize, and it's a very significant conversation which we are.
So quickly, just to address that, and you can see that what he has pointed out is that as the government does structural reform and as we get into a debt negotiation, the likelihood is that your government is going to need less and less capital, because this is what happened in 2006. The government borrowed less and less from the banking sector and relied more and more on tax revenue. That's what the government did, and they kept within a specific budget. So they did not expand their spending too much, and they just kept within a certain band. So this is what you will expect coming from this administration, and they signaled it in their budget that last year they got 24. They budgeted for 24 billion kwacha coming from government bond issuance. This year they're budgeting only from 15 billion kwacha from domestic borrowing. So you can see that the government does not seem to finance this budget using domestic. They don't want to use too much domestic borrowing, and they want to slim down their domestic borrowing. So already that tells you that they are gearing themselves for that. And with lower bond supply, you've got less pressure on interest rates to go up. And as long as you got the participation or the return of participation of the offshore investors who are snapping up bonds at record rates in Mexico, Indonesia, Saudi Arabia, and also in corporate bonds right now, the appetite for global bond investors is really high. So as long as you get rid of that barrier of the debt negotiation, once that comes down, then you got a lot more people comfortable to come in. And once the haircuts are clear, once they see who's getting a haircut where, once we're clear as to what that is, then people feel more comfortable coming back into your economy and then pushing your interest rates down. So even to local bond investors, this is why I've been saying to you people, in the first half of the year, pile in, because once you can actually get in faster in this period, this is the higher yield portion. Because once these first 6 months are gone, you're running the risk of now competing at a higher inflation, which is now sitting at 11.1% and 10.1%, versus investors now who are going to be dealing with, versus investors who are coming in for 5% against their country, and you're trying to now compete with them. They bring your rates down to 10-something%, and you're only covering inflation in your bond market for the next 2 years, meaning that you're going to be making negative real yields for the next 2 years, a negative return on investment for the next couple of years, you as an individual investor. So your best bet right now is to pile in now before the rates collapse, because the only thing that's standing between a rate collapse the only thing that's standing between now and a rate collapse is the debt being reprofiled. That's really what's standing between it. Because once you get that rush of capital coming back in, trying to get higher interest rates on our currencies, then it becomes a death toll when it comes there. One more thing that they did answer, and I want to quickly share this, Brennan, as we wind up here. One more thing that they did address was the FX stability. We did talk about trying to find alternatives to the current FX regime, and we'll quickly switch to that. And this was a question again brought out by our own Cecilia. Did go through FX regimes. Is it not possible to a system when it comes to FX?
Since the last week, we have seen the US dollar get stronger by 16%, and the kwacha enter its second longest losing streak on record since 2006, on 92 consecutive days, even within the face of the central bank selling dollars into the markets. Is the central bank this time more supportive of calls from market players for open market FX derivative contract market, as opposed to current system of spot trading and highly expensive bank forwards?
The call that we hear from some of the private sector in particular, is that you see, there is nothing, we are in a liberalized environment, which stops any of those to strike deals with their banks or financial institutions. But what tends to happen is that they want the counterparty to be the Bank of Zambia, which means that the risk one is to rest with us. Now, as an institution, we are not in the active business as they are. So you can very well imagine, why would the Bank of Zambia, using public resources, anchor an private profit-driven motivation? I think you can see, you raise the first question of the morality of it, of if they are making profits. Now imagine the central bank comes out, you said, yeah, you go out, you strike a deal, then you come and say, okay, guarantee me that I pay you even if that deal goes bad. That's why there is insurance. We don't use much of it. Go to the insurance, they will do that. That's the hedging. But the typical proposition is that let the Bank of Zambia be the counterparty which takes the risks, and you as the private sector player, you are risk-free. That's not very prudent, is it? Actually, you come down to us, you said, no, how could you do that? So that's, those who are asking you those questions, ask them, what financial institutions have they approached? Yes, in other jurisdictions, this happened, the forward market, but that is an arrangement between the parties. We have seen even banks coming, wanting to be counterparties to us. Say, but why don't you engage with the others to do this? So this is one of the challenges which is there, and we are able and willing to discuss this in greater detail so that we can pinpoint some of these. But as things are, nothing stops anybody to engage in forward or derivative operation. But once you also go into derivative, though, we have to see if it's a bank which is involved, it has to spell out what risks they are facing, because if they do face challenges and it's a systemic institution, it has the potential to undermine the stability of the entire system. So we take interest in that. So stability of the system is our core need, and the a lot of price stability.
Okay, so just a quickly roundup of that. Sorry, just a quick final roundup of that. I will give my thoughts on that, especially the futures market and that. But I always will say that the problem with our financial sector is that our banking sector has got a bit too much of a leg up it's got too much of a leg up when it comes to this. The banking sector does control things like the FX rates. They have got strong controls. And the problem is when you try to go to these institutions to try and participate in some sort of derivatives and hedging instruments, they price the people out so badly and they make them so expensive. So what we were trying to talk about when we said do this on an open market is you actually need exchanges for these contracts. Exchanges bring the prices down because now they make transparent everyone's forward positions, because you have to individually go into each bank and try and negotiate. There's so many rigorous procedures. It becomes very difficult to get one of those contracts in your hands. And because of that, banks have a huge advantage over the person requesting that position. So risk products need to actually be expanded to FX hedging products and other risk products. And he's right. Insurance companies do the mind share of this kind of trading in other countries and also some parts of the banks. It would be a good idea to see risk products such as FX hedging. We've seen it in the agricultural space to try and bring agricultural futures onto the market. If we can try and get a futures market going, where people can buy contracts in this regard, we can actually see a little bit of an improvement. Vernon, on Friday, tomorrow I'll break down a conversation that came out about the green economy and about green business. But I'll be sharing most of these slides, people, on my page. Please take a look for them. You will see most of this information, and will be also distributed to Money FM as well. So this is information that's coming out. Headlines, once again, inflation projections, 11.1%, 10.1% in the next year. So prepare yourself for higher than expected inflation over the next 2 years. And also interest rates will sit up a little bit, but yield rates are likely going to collapse once structural reforms are done and offshore investors return to the market and the haircut conversation is dealt with. These are the key things you want to take out of this MPC meeting. With that, thanks a lot, Vernon, and thanks a lot to everyone. I know we took this into overtime, but this was one of those crunch time games. Thank you to everyone, and I hope that answers some of your questions.
Indeed. Thank you so much.